There were a lot of changes last year. One of them had to do with the 20% qualified business income deduction, an opportunity for small businesses to be able to take a deduction for 20% of their profits before they pay their taxes.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 164. We're getting into tax season, and every year around this time, I like to talk to Duane Culver because he's the RPOA's go-to CPA. Duane is from Culver CPA Group. He's here today to give us a tax update for 2018. As we know, last year, there were a lot of changes. And if you want to hear more about those changes, you can go back and listen to last year's episode. We're not going to rehash that. I thought it'd be good to have Duane back to just kind of talk about anything new that we need to be aware of, any common questions that he keeps getting in his CPA firm. And then also we're going to discuss opportunity zones at a very high level, basic overview of what opportunity zones are, because I know a lot of us have been hearing about them, and it would help to understand what their opportunity is. So Duane, thanks a lot for coming back again this year to talk to us about taxes.
Thanks for having me.
What do we need to know this year? I mean, last year you did a great job of just breaking down the new tax laws that had taken effect. What do we need to know this year?
There were a lot of changes last year, and we hashed those out fairly thoroughly last year. But there were some uncertainties, some things that we didn't know for sure. One of them had to do with the 20% qualified business income deduction. And that was an opportunity for small businesses to be able to take a deduction for 20% of their profits before they pay their taxes. And the question was, well, does that apply to rentals, for rental real estate? And there was uncertainty. At the time we were saying we think this will apply, but often we treat rentals differently than other businesses. They're taxed differently. At this point, it looks like most of the time they will qualify. When they won't qualify is if you have, a commercial property, typically on a triple net lease, where the landlord is not responsible for anything going on in that property.
So that would be like a retail or industrial type property where you're leasing it out, and the tenant is paying all of the expenses, including taxes and insurance and everything.
Exactly. Yes. Maintenance. If the roof goes bad, the tenant pays to re-roof it, etc. So where the landlord's getting a fixed amount, has no expense related to that.
So the what is the qualified business income?
It's qualified business income deduction.
Mm-hmm.
Yep.
And that does not apply in those triple net situations.
It does not apply in a triple net situation.
But it would apply to, say, residential, multifamily, or commercial?
Yes.
Okay,
yes.
So
Most of the time. Mm-hmm. Another time it would not apply would be if you rent the building to a business that you also control. In that case, it still could apply, but it's going to be based on whether or not that business qualifies for the qualified business income deduction. So if that business is, say, an accounting firm like my business, that is a specified service, trade, or business that does not qualify normally for the deduction unless my income is below certain thresholds. So the rental of property to that business is going to follow the treatment that business has. So if you have a business, if that business qualifies for the deduction, property you rent to that business will also qualify for the deduction. If the business does not qualify, property you rent to that business also will not qualify.
Okay. So let's take this back to commercial multifamily, because most of our investors or most of our listeners are, I would guess,
Sure.
based on what I know about our audience, are interested in the residential side.
Right.
And I own a commercial apartment building.
Yep.
So what does this qualified business income deduction mean to me and the LLC and my investors?
So the net profit from that commercial rental is going to be the lower of that net profit or your taxable income. And whichever number's lower, basically we can take 20% of that number and subtract it from your income before we calculate your income tax. So you get a deduction of 20% of your business profit before we calculate your tax.
Let me wrap my head around this. So I can take 20% of my profit, and this is after my income and expenses.
Yes.
And my mortgage as well, and depreciation.
The mortgage interest.
The mortgage interest.
After depreciation.
After depreciation. So whatever's left after that point.
Right.
Let's say there's $100,000 left. I can take 20% of that off.
$20,000.
$20,000 off of the amount that I'm going to end up paying taxes on. So I'll only pay taxes on $80,000.
Yes. Right.
Okay.
There's some limits. We talked about some of these limits last year. If your income, for a married couple, if your taxable income is over $315,000, and for any other filer, it'd be half that number, $157,500. If your taxable income is over those limits, we have some additional criteria to meet besides it just be from business income. So the additional criteria is that 20% deduction cannot be more than 50% of the wages paid. Well, most of your audience very well may not be paying employees. You might not have any wages you're paying.
Right. So that doesn't matter.
So then that would disqualify the deduction. Does not.
Wait. Okay, I've got it backwards. So the deduction would be disqualified if your personal income does not equal half of the wages that you pay your employees?
The deduction, $20,000 deduction that we just referred to, cannot be more than 50% of wages paid. So if you're not paying any wages, you don't have employees, wages are zero, 50% of that is zero. So your $20,000 can't be more than this zero. So that would eliminate your deduction.
And is that only if you and your spouse are making over $350,000?
Yeah, $315,000.
$315,000.
Right.
Okay. So if you're making $100,000,
yeah, if your taxable income is less than $315,000, we don't have to worry about these additional requirements.
Gotcha. Okay.
So it's only for somebody that's making, a little bit on the higher income side.
I feel like they locked a bunch of crazy people up in a room and said, come up with some rules that can just drive real estate investors crazy.
And what I appreciate about the approach is that for the small business person that doesn't have high income, they've taken away a lot of restrictions. So they've opened it up. So
these rules are good for the smaller investor.
Yes, because as long as their income is below $315,000 for married, half that number for somebody that's not filing married, then they don't have to meet these additional requirements.
Let me ask you this. So if our listeners are out there and they're doing their own taxes and they're not using the services of a CPA like yourself, is it conceivable that they might be completely unaware of this deduction and not getting it?
Yes. And the software might be asking them questions.
So they might be using TurboTax.
But if they don't know why the software is asking them questions or quite how to answer the question right, they may get this wrong.
Mm-hmm. So some investors might be leaving some money off the table or paying more toward taxes than they should.
Certainly. Because not every rental, software is not going to necessarily think that every rental is a trade or business. Mm-hmm. There's one other way to qualify, though. We talked about for that higher income person, whose income is above the threshold that we talked about. They only get the deduction if they're, if we said it, to the extent the deduction is more than 50% of wages. If they're not paying wages, there's another test. So the second way to qualify is to use 25% of wages, which is still zero, plus 2.5% of the unadjusted basis of the property, excluding land. So let's say we paid $120,000 for a piece of property, and we separated $20,000 out for the land. So we have a $100,000 investment in the building. 2.5% of that would be $2,500. So profit from that building after all of our expenses for the year, property taxes, insurance, everything else. If our profit is $4,000, let's say our profit's $10,000. If our profit is $10,000, 20% deduction of that profit would be $2,000. So we could, instead of paying taxes on $10,000, we'll pay taxes on $8,000. But our $2,000 is limited to 2.5% of our basis in the property, which would be $2,500. Our $2,000 fits within that, so it's not limited.
Okay, so you get the $2,000. You wouldn't get the $2,500.
No, $2,500 is a limit of how much your deduction could be.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So that's a way, if you're making over $315,000 a year, but you're not paying wages, that second way of qualifying for the exception is probably the way you're going to go.
Yes.
Okay, so there is still hope for those who are making over $315,000 a year.
There's hope. It's a complex calculation because now you're looking at the basis of property and so forth. And the basis does expire. So whatever you invest in property, you get to count that for 10 years or for the depreciable life of the property. So as long as you're depreciating the property, you can count it. So if it's residential property, that's probably 27 and a half years. If it's commercial property, it's probably 39 years. But as long as, it has a depreciable life, you get credit for it at that time. If it's a piece of property you've held for 40 years or something like that, the basis is only going to be, the basis that you can use for this calculation is only going to be, improvements you've made since you first acquired it.
Right. Like if you put a new roof on it, you'd still be depreciating that maybe.
Right.
So again, in TurboTax, if I'm doing this on TurboTax, is this something I might easily miss as well?
I don't know exactly how TurboTax works and what it will pick up and what it won't. But
pretty complex though.
But if you know the rules, you'll know whether or not the software is doing what it should or not.
So getting away from the qualified business income deduction, what are some of the other questions you're getting this tax season?
A question that's come up a few times, I realize most of us have life insurance, but not life insurance. Most of us have health insurance. But I do get the question, what if I don't have health insurance? Is there still a penalty? Question I got yesterday was, my parents are living with us and he doesn't have health insurance and, can I claim him? And initially, because he had no income, we said, well, you could claim him. But then the concern was, well, he doesn't have health insurance. Will I pay a penalty? Well, now we have to, look at doing a calculation. Does it make sense? Because the law has been changed. There are no penalties, but that change is not effective until 2019. So for 2018, we still have a penalty if you didn't have the health insurance or don't qualify for one of the exemptions.
Yeah, is that penalty diminished in any way, or is it still the same penalty that it would have been in 2017?
It's still the same penalty.
Okay, so be aware of that. There still is that, I keep wanting to say Obamacare, but it's the Affordable Health Care Act
Right.
penalty for not having health care is still due for 2018, for the year 2018.
Yes.
Okay,
Yep.
but next year when we're sitting here, that will no longer be the case.
Exactly.
Good to know. What are some
Yep.
other things that our listeners need to know about their taxes?
Just a reminder, this is something we would have talked about last year. Tax rates have dropped, so we're probably paying less income tax most of the time, but we no longer have personal exemptions. So for our children under the age of 17, we now have a larger child tax credit. It went from $1,000 to $2,000, which largely offsets the fact that we lost exemptions. For our personal exemptions, we have a larger standard deduction now instead. So we don't have an exemption, but we have a larger standard deduction. The standard deduction, though, about 40% of the population, I think, probably itemized deductions instead of using the standard deduction. So because the standard deduction is so much larger than in the past, fewer people will itemize deductions. And those are the people that, may not see as much advantage from the tax law change because they were already getting deductions. This new larger standard deduction probably doesn't help them. They've just lost their personal exemptions. One tool that I advise people on in order to still be able to itemize deductions, maybe not every year, but maybe every other year. And that is, if they're charitable minded, they can use a donor advised fund to make 2 years worth of contributions in 1 year to the donor advised fund. And then out of that fund, send money to their favorite charities each year. So the charities get money every year, but they can take a charitable contribution every second year when they put money in this fund. And then in those even years or odd years, however they choose to do it, they'll have higher deductions, be able to itemize, get that tax advantage, and in the off years, use the larger standard deduction that they're given.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. So whereas before we used to be able to just take deductions for our charitable contributions, now you're saying because of the standard deduction being higher, people aren't itemizing as much, so this is another way to get some deductions for their charitable contributions?
Exactly, yes.
But it's an extra step, though. They have to set up some sort of charitable fund?
Yes. We call it a donor-advised fund, and there's a lot of organizations that can handle those. Fidelity is the largest charity in the world, and so they'll handle it. But there's also...
Wait, Fidelity?
Fidelity has donor-advised funds. But also the National Christian Foundation, Barnabas Foundation, there's Catholic
Seems
charities.
like wouldn't there be an extra cost, though, in setting up one of these funds? And
there are
putting your
fees.
money?
They're not excessive. It may depend on how much is invested. The larger investment is going to have a little bit higher fees. You're essentially paying somebody to manage these funds. But in an account I opened, the fee is $20 a month.
Mm-hmm.
And, my tax savings by putting money into a fund like this, is going to more than take care of that.
Is there a limit to how much you can put in this fund?
There's no limit.
No limit, but there...
For a deduction, you're limited to 60% of your income.
Okay, so you're limited there. And
which is high enough for most people.
And you can only deduct it once every 2 years.
Well, the goal is, for a married couple, the standard deduction is now $24,000. For somebody not filing as married, it's $12,000. And that's high enough that and you're limited to $10,000 for state income taxes and property taxes and other things. So, unless you have a large mortgage, paying quite a bit of tax to the state, and also make significant charitable contributions, you're going to have a hard time getting over this $24,000 number.
Sure.
For many people. But if they take their charitable contributions and combine 2 years worth into 1 year, now maybe it works.
Okay. So this charitable contribution fund and the deduction would still only apply if you're itemizing your deductions. It's not a deduction once every 2 years on top of your standard deduction.
Right. Yes. It's a tool to help you be able to itemize every couple of years.
So if you build up 2 years worth of charitable contributions, you might have enough itemized deductions at that point to be higher than what your standard deduction is.
Yes. Yes.
Well, let's talk about opportunity zones.
Okay.
I know you've got just some high-level basic information. I don't want to get too detailed into opportunity zones, but I know a lot of people are hearing about them and just want to understand a little better what do they mean. Is there opportunity for investors there?
Right, and there are. So there are certain zones throughout the country that have been nominated by states to the federal government, and the government's approved them, where a typical characteristic of these zones is there's been a lack of investment in these areas. So typically incomes are pretty low in these areas, and it's not a place where business has naturally, without an incentive, wanted to go invest money. So there's these specifically designed zones all over the country, and here in Michigan, they're all over the state. And the opportunity is to sell property that you have and realize hopefully a large gain. Right now, locally, real estate values have increased significantly, and you have the opportunity to recover those gains that you've earned by selling something, and then taking the gain and investing in this opportunity zone. You have 180 days to make the investment.
So is this like
sale.
a 1031 exchange that you'd be doing?
It's different than a 1031 in several ways. It doesn't have to be in real estate. You could buy machines. It could be a business that you buy. It just has to be.
So I could buy a business in an opportunity zone. Huh?
Yes, or set up a business. Yep, and use the gain from the sale of anything. It wouldn't have to be real estate that was sold. Typically, when we're talking about real estate, but this is bigger than real estate. But you sell property that's appreciated in value and reinvest it inside one of these zones within 180 days. You don't have to reinvest the portion of the sales proceeds that's not gain. Really, the intention here is actually you take only the gain portion of your sales proceeds, and that's what gets reinvested. If you do that, you don't have to pay tax on the gain until the year 2026. And if you've held it that long, potentially, instead of paying taxes on all of the gain, you're only paying taxes on 85% of the gain. After you've paid that tax in 2026, if you hold the investment for at least 10 years, there's no tax on the future gain.
So all the gain would be tax-free?
Yes.
What about the initial gain that you invested?
The initial investment that you made, well, the initial gain that was invested in this property, you're paying tax on 85% of that in the year 2026. But that's the only tax. And then future gains, if this investment doubles or triples in value, there's no tax on that.
This sounds like a way for people who have property that they want to sell, but they don't want to pay the taxes on all the gains that they've made over the past 10 years. They can take just those gains that they would normally pay taxes on and invest it into one of these opportunity funds.
Yes.
And then keep but they're only investing the gains. So the initial principal that they originally invested, they could put that back into their pocket.
In their pocket, or invest somewhere, invest elsewhere.
And not pay any taxes on that.
Right.
So
in fact, if they take that principal portion and invest it in the same zone, their investments can be treated like two separate investments. because the principal portion they invest is not going to qualify for all of these tax incentives. It's
Only the gain that they're
yes.
making when they sell their current property.
Yes. And the gain could be from the sale of stock or a business, a vacation property, cryptocurrency, anything.
So it sounds like this is an alternative to a 1031 exchange, whereas with a 1031 exchange, you'd be putting both your principal and your gain into a new investment and not paying any taxes,
right.
deferring taxes.
Right.
But this allows you to keep your principal once you sell your current property and take just the gain that you would normally pay taxes on and invest that into the opportunity zone.
Yes.
That's interesting.
There's a lot of rules around this, and it can get quite complex. Delve into this in a future podcast.
Yeah. I know that people are setting up, you have to set up an opportunity fund to make this type of investment, right?
Exactly.
And the opportunity fund could be multiple people putting their money in, taking that money and putting it into it. Or it could be a single individual just
It could be a
rolling
single
their
individual, but you're going to want to probably use a corporation to make that investment.
So the opportunity fund would be like an LLC that would be set up.
If it's an LLC, it will be an LLC that elects to be treated as a corporation, an S corp or a C corp.
Okay. How are you seeing investors or investment groups take advantage of opportunity funds right now?
I've not worked with anybody actually setting one up right now. I've not, personally. I do have some people though that are asking me for options because they have some gains and they want to know what to do with these. What can I do besides pay a lot of tax on them right now?
Right.
One of the things I do try to point out is we are in a period of time where our taxes have just recently decreased. Long-term, taxes are going to have to go up.
You don't think taxes will keep going down?
This is not sustainable for the next 50 years. That someday taxes are going to be at a higher rate. So it's a question of timing. Does it make sense for me to pay taxes now at a lower rate, step up my basis, and start my deductions over again and use these deductions to help offset income in the future when I may have higher income and be subject to higher rates, either because of my higher income and or because of changes in the law.
That's an excellent point. However, if you do invest your gains in an opportunity zone and you're there for 10 years, then you don't pay any taxes, right?
Exactly.
So that's another consideration. So you got to balance it. How long are you going to stay in that investment in the opportunity zone? Now, if you're just an investor who's not going to take the gains from of the property they just sold, and you just have, say, $1 million that you want to invest, would you benefit by investing in an opportunity zone?
Yes. You use that opportunity zone to, instead of paying taxes on $1 million, maybe now I only pay taxes on $850,000. And the growth of that $1 million after 2026 will be completely tax-free.
So all the gains on that.
It's actually the growth from when I invest it.
Okay.
Because I'm investing $1 million, I haven't paid taxes on it yet. I'll pay taxes on $850,000 in 2026, but the growth of that $1 million over time will be completely tax-free.
So it makes sense for anyone who has the money and the inclination to invest in an opportunity zone from a tax standpoint.
From a tax perspective, this is a great opportunity. Finding the zone that you're comfortable making an investment in, is where you have to do the homework.
Yeah. And for property owners who own properties in opportunity zones, and by the way, these maps just came out recently. So I actually found out I have 2 properties in opportunity zones. What does that mean to me?
Nothing, unfortunately, unless it creates an opportunity for you to market it because you want to sell it.
If I wanted to sell it, I could get a higher price because
to an investor,
someone with an opportunity fund might come in and pay a higher price for it.
Yes, and so you could market it that way as, hey, here's an opportunity for somebody to reinvest, and then you could take the gain you've made on those and buy another property in that zone.
If I have an apartment building, an existing apartment building that was, say, built in 1980 in this opportunity zone, and someone bought it with an opportunity fund, what are the requirements for them? I mean, what do they have to do in order to, comply with whatever the opportunity zone rules are? Could they just operate it as is and continue receiving the cash flow from it? Or would they have to add value in some way to be able to comply with the rules of the opportunity zone?
Yeah, the Qualified Opportunity Fund would have to substantially improve the property. To qualify, they have to be considered as the first user of the property. So it must be, either a new development or substantially improved. And, we have to separate the land from the building. And it's, the building, anything that's an addition or improvement needs to be more than the original basis of what they bought. So if they paid you $500,000 for this building, and we separate out land, say that was $100,000, so they have $400,000 they've invested, they've used to purchase the building. They would have to make improvements to that building of at least $400,000 to qualify.
Okay. There's some substantial work that needs to go into they would either have to tear down the existing building and do a new development or do a complete top to bottom rehab of the existing building.
Yes. Yep, they would.
Anything else that we should know about opportunity zones from kind of this high bird's eye perspective?
Yeah, it can be property acquired after 2017.
So if I bought it in 2018, it could retroactively qualify.
Potentially. Yep.
But even though I didn't form a opportunity fund?
No, it would have to be held in an entity that qualified as a qualified opportunity fund. You'd have to have gains that have been reinvested.
So it's too late to go. If you bought a property in 2018 and you found out it's in an opportunity zone.
You'd have to have unique circumstances that fit well to make all of this work.
Okay.
Yep.
But that's good to know. So if you're in the process of buying a property or you own some property, check to see if it's in an opportunity zone, because you never know. I was surprised to find that I have 2 properties that are located in opportunity zones.
Right. Yes. This is a unique opportunity.
Mm-hmm. Well, that's great to know. Duane, once again, you've really helped our listeners with their tax preparation.
Good.
It's good to have you back. I think this is the 3rd year we've done our tax update.
Yep.
So I really appreciate you sharing your wisdom with us, especially during this very busy tax season. So thank you very much.
You're welcome. Thank you for having me.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.